Hello dear friends, I'm pleased to greet you online. Today is Tuesday, June 29th. Here is a fresh review prepared for InstaForex. Today is interesting commemoration day in Russia, day of partisan and underground resistance. Commonly, these people have a grim fate in Russia. Some people have been involved in secret activities and long ago in the modern history. Nowadays, these people are operating in the digital world. For example, bloggers in Belarus and Russia, at present they have to hide somewhere in foreign jurisdictions, but not deep in a forest as they did last century. Now back to financial markets. Crude oil is overbought. There is a sparse supply of crude now in the world. Consumers complain about the lack of oil supplies. As a result, oil is trading at highs last seen in 2018. The landmark event for the oil market is the meeting of OPEC and its allies, scheduled for this Thursday. The cartel is wildly expected to scale up oil production quotas, so oil prices could make a downward correction that is also anticipated by petroleum buyers. Oil exporting countries will increase production capacities and eventually oil prices will halt the rapid rally. Based on this assumption, I have a trading idea which I am already implementing with the USD CAD pair. This is a buying idea which rests on the advance of the US dollar across the board. I have the bearish outlook for those currencies where crude oil is a crucial source of national budget revenues. I mean the Canadian dollar. I will explain it in detail later. This idea is very simple. In fact, the greenback is rising against all rival currencies. At the same time, oil is trading at highs, perhaps bigger than expected increase in oil production rates that will be announced on Thursday could trigger growth in the instruments impacted by oil. For the USD CAD pair, I expect a three-way structure upwards with high targets. Meanwhile, the US stock market is breaking new records, extending its stunning bullish run. We have taken part in this rally and now we're just watching and waiting for a correction. The first chart to discuss is gold. Yesterday, my trading idea about growth of the gold price failed, so I closed my positions having lost 35 pips. The trading idea was about making a new level which is seen badly on a 1-hour chart but seen clearly on a daily chart. Inside the bullish wave, I bought at 50% Fibonacci level at a retracement. The third wave was about to emerge, but Asian and European traders blew out that wave. I decided not to wait until a stop loss is triggered and exit the market a bit earlier. Following my method, hunting for stop orders, this decision enabled me to reduce my loss. I could have incurred a twice bigger loss, but made the loss of 35 pips. However, the euro-dollar pair worked out this idea just fine. It happened yesterday. Well, technically the euro is more predictable, but the euro-dollar pair is the most technically efficient instrument where I can apply my method hunting for stop orders. Back to gold. The level spotted by me remains untouched. The price still can reach it. My failed idea was to work out that pin bar and a move across these highs. It was logical following a steep fall. Perhaps it will happen today in the American session, but I don't expect appropriate market sentiment. Gold could hit a lower low of June and create some impulse. We will catch this impulse. In case the price makes a 50% retracement, we could open long positions in that blue zone in condition of strong buying pressure. As long as there is no buying pressure, we should just sit and watch gold moves. The euro-dollar pair is going on with its decline after a pin bar that appeared on Friday. The selling idea worked well on another pin bar. I don't have new ideas to advise you. Why? Because the selling idea can be implemented the best through the pound sterling against the US dollar. In fact, I have spotted interesting levels to trade the pound-dollar pair. Let me show you on a weekly chart. This small pin bar at highs is the stronger mark of the year. In case selling sentiment arises, it would be logical to sell the pair from the highest point. My idea is to open short positions on the pound-dollar pair, predicting the fall of the instrument as low as 1.1366. This idea was based on obvious selling sentiment. There was a 50% retracement. If you open positions at 50% FIBO, the first take profit could be 200 pips and the second one at 323 pips. The selling idea for gold based on the greenbacked growth was a hedging idea relative to the euro-dollar pair. I think it is right to lose 30 pips and then take a profit of 200 pips or 323. Oil is trading at elevated levels. Someone predicts oil to climb to $100 a barrel. Currently, I see that oil is approaching the levels of 2018. The price has to move 300 pips from the current levels to get there. Speculators are well aware that OPEC is likely to increase oil production quotas, so oil bulls will close their long position. Imagine you are a speculator keeping long position on oil and expecting a profit of $1 million. You understand that after the OPEC decision, oil prices will fall in a couple of days. You are running a grave risk. What will you do? You will certainly push the closed positions bottom. There are hundreds of even thousands of such speculators. Hence, massive profit taking could lead at least to a steep drop of oil prices. I mean that such corrections are a common practice before landmark events. Personally, I'm a fan of simple and technical analysis. From my point, the level of $76 is the level of fear. Being unnerved traders fix profits. The prospects of profit taking gave me a trading idea for a climb of the USD-CAD pair. I'm anticipating the third wave. This is clearly seen on a daily or 4-hour chart. After the lows of 2018, oil gained a bullish momentum. I have a crazy ambitious plan that the pair could skyrocket 25,000 pips. It's the historic highs anticipated by me. I wish this idea would bear very soon. That's all I wanted to tell you today. The euro could gyrate. Please be careful with the euro tonight. See you later. Bye bye.